Welcome to the daily update, where I'll go over the action in the market for Wednesday, January 3rd, and then we'll see how things look for Thursday, January 4th. Had another down day. It was almost a carbon copy of what we saw on Tuesday. This idea that the market was magically supposed to go up almost automatically, well, somebody seemed to have forgot to tell the market that's what it was supposed to do, and now we've seen two down days in a row. We're still maintaining a positive stance in the intermediate and long term, but we're coming down to those 20-period moving averages now. Is that going to provide some kind of support? You have a lot of people that pretty much expected the market to go up from here, and it has not done that. That's caused some confusion, a little bit of doubt. That's what the market likes to do. If the market is going to make a stand and turn and go up from here, maybe a little bit more of a shakeout is due before it turns to go back up. However, if we see prices fall below the 20-period moving average and more weakness develop, this could even shake out a few more folks. We're still dealing with a slightly overbought condition, but it is working off right now, and we're just kind of trying to figure out, okay, things aren't really working out the way the market thought, a lot of people thought it would. And that's what happens. If you remember a year ago, it was pretty much a foregone conclusion that the beginning of 2023, the market was going to go down. What did it do? It went up, and it defied logic. And that's what the market likes to do. That's why we look at so many charts. That's why I look at a lot of different things to reach a consensus conclusion. Because if you just settle on a few indicators, yeah, they might be telling you a story and you could be right. But when you're wrong, that really can come back to bite you. All right, let's go back and talk about what happened. At the open, pretty much the same as what we saw on Tuesday. We saw a gap lower open. Prices dropped down below S1 at 47.26. We found support slightly below S2 at 47.08. We're getting down to that 4,700 level. Now, the numbers are different, but this is pretty much the same sentence that I used to do the video after Tuesday's session. Then prices attempted to bounce up from S2 and failed, the same as what happened on Tuesday, and then rose up to S1. As the day went on, we fell down from S1 back below S2, and we found support at about 4,700. We ticked just a little bit below that, and then we closed pretty much at the low for the session. The very end of this is different from Wednesday, from where it was on Tuesday. We were down 0.8% on above average volume, so that is starting to pick up again. And as I said, we're still in this positive stance technically, but if we see more weakness, that could shift the short term over to negative. If we see some real convicted selling, that could even start to wreak havoc on the intermediate term. Right now, these are just warning signs. We want to just see what's the follow through going to be from here. The market is still fixated on inflation and interest rates and growth concerns, and then keeping an eye on the different geopolitical events. Some comments: there's no Santa Claus rally this year. We ended up the 5 last days of 2023, the first 2 days of 2024, we ended up being down. So that is not going to figure into the +1 as far as the trifecta, which a lot of people just assumed was going to happen. Now we have to ask the question, the January effect, which has been giving a lot of support to small caps and even into mid caps, is that over now, or is that going to resume? Even when we look at historical charts, there are some hiccups along the way, so it doesn't necessarily mean that we can conclude that right now. We can conclude that the Santa Claus rally was over because that's a defined period of time. The January effect is a little more elusive with when it starts and when it ends. Small caps underperformed. They're giving back a lot of their gains after they really saw a good run up in December. Growth continues to underperform value. That seems to be a consistent theme that's going through this. And I've been trying to point this out in the videos that at some point the market is going to reckon with this. Is the reckoning over, or is the reckoning just getting started? Selling kept going even after the FOMC meeting minutes were released. The S&P is still above 4,700. We're going to be watching that. It's more of a psychological level. Now that we came down to that on an intraday low, that's going to turn into a technical level. We'll be waiting to see if we can bounce up off of that or if we're going to continue to fall below it. It's also showing up on some charts that I'll go through. On a short-term basis, now our list is pretty short. We still have the ADX, which is weakening, so you could almost take this off the list. The reason it's on the list is it's still above 40, and that's a very extreme reading, but it's dropping below its moving average. Some of our stochastics charts are actually turning more neutral now, even to negative, but our longer-term stochastic is still extreme positive. And we still have the Stoch RSI, which is extreme negative already. It was that way after Tuesday's session. It remains that way currently. Intermediate term, our list is getting shorter, but these are things that if they flip over and turn more negative, could change the overall atmosphere of the market. Again, we have our ADX, which is dropping below its moving average. The 50-period exponential moving average, yeah, it's turning down, but it's still extreme positive. The rate of change 50 continues to be quite extreme. The PMO and the studies that we look at, they're rolling over and starting to turn more negative, but they are still extreme positive. The Chaikin money flow, the bullish percent index for the S&P and the NASDAQ 100, and our new high, new low study based on 10 periods, that's still pretty much camped out at the top level of its range. Long term, we're still above the 150 and 200 period moving averages that we follow. Then I've added one more line to this scenario. The Fed might be done raising rates or even cut rates. That's kind of the new scenario the market's been adopting. And that's why there's this, oh, the market's just going to magically go up. But now, after the meeting minutes came out, I had to add this next little line here. They're willing to raise rates if strength returns. And that put a bit of a check on the market. We're going to be watching all of these economic reports as they're coming out. If they come in stronger than expected, that's going to be negative. If they come in weaker than expected, that will be positive. So we're still in this phase where good news could be bad news and bad news could be good news. The dollar was up, which put pressure on stocks, but interest rates were down, and that didn't really give much support to stocks. The 10-year yield closed at 3.94%. We still have our yield curves that remain inverted and are even becoming more inverted. Sentiment is no longer extreme. Now, look at the context of this. We went up and had a really high reading. We got up almost to 80, and now we're starting to come down after being extreme positive. We're still positive now, but it's now showing more of a decline. So this is when sentiment was getting pretty extreme. Now, we could always turn around. There's room to turn and go back up here, but we want to be aware that right now, in the short term, the market seems to be on the defensive, but we are at some support. Our trend is still positive. The green line is still on top, even though it's declining, but the ADX is dropping below its moving average. Our bias is negative. We've had 3 down days in a row now, so I've also changed our momentum over to negative. Some economic reports that came out. We did get the weekly MBA mortgage applications index. It was down 9.4%. It must have been taking some time off for Christmas. Last time it was down 1.5%. ISM manufacturing. This came in a little bit stronger than expected at 47.4. They expected 47.1. Last time it was at 46.7. Please keep in mind that this is still below 50. So we are showing contraction in the economy. We're going to get the non-manufacturing later. That's more services oriented. And so far, that's been above 50 because of the shift that we've seen in the U.S. economy, changing from a manufacturing type of economy over to more of a services economy. The JOLTS job openings continue to decline. Still a lot of jobs out there at 8.79 million, but it's down from the 8.852 million that we saw last time. Here are some charts showing week over week how the mortgage applications did decline. And then here are the job openings where they're still positive, showing that there's jobs out there. But we have been seeing a gradual decline over the past few months. This is the ISM index. The blue line is the total. It's really hard to see because it's right on top of the yellow line. We are below 50, even though it's looking a little bit flat here. The orders are picking up. That could show some economic strength there. And the prices versus deliveries, where we're seeing an increase in prices, that's a bit inflationary. And the deliveries are pretty much flat to slightly declining. That doesn't necessarily show growth. Then we're looking at imports versus exports, where they both are showing a decline. And then on the the month over month basis here with the ISM index, it was pretty much flat based on looking. I think this is month over month. It might be year over year, but it's pretty much flat from the previous reading. Here's our intraday chart, where if you looked at Tuesday's bars, we gapped lower, went down to S2, tested it, bounced up to S1, went lower. Same thing happened on Wednesday. Gap lower, below S1, came down to S2, tried to bounce, came back down to S2, made it all the way back up to S1. Then this is when the meeting minutes were released, and that saw more selling going into the close. We didn't close right at the low, but pretty near the low. Here's our intraday chart, where we were pretty much flat in the initial overnight session. Then we started to go negative before the market opened, and that's what produced the gap lower. We have the choppiness that occurred during the day, and we're actually up just a little bit in the initial overnight session. This is also a concern. We're still seeing growth underperforming value. And if we want these indexes to go up, we need to see growth outperforming value, where the blue line continues to decline. The red line was down too, but it's down less. And here's the intraday chart for the S&P, where again, we saw the big gap in Tuesday's session, but we're not really showing any strength here intraday. So when we look at the end of day chart, both growth and value were down, but growth was down more. And look at this for the mid caps. My goodness, it was down less, but it was still down 2.25% for the mid caps. Also, really a lot of weakness here in the small caps, even though it was down less than value. This whole area, the small and mid caps, just got taken out and shot in Wednesday's session. So I wanted to bring up the growth to value charts for the small caps, mid caps, and large caps here. We are seeing some weakness here. We were getting up kind of in this range where we were closer to the bottom part of the range, showing a little bit of improvement. Now we're starting to go back down to the lower part of the range for the small caps. This is where we were getting some hope at the latter part of 2023. We were seeing some strength in mid-cap growth compared to mid-cap value. Now it's starting to show some weakness. It's still hanging in there for right now, but it's really come down. And this is the thing that's more concerning for the S&P 500. We're just really going down with the growth to value ratio as the index was going up, and now price is starting to confirm the decline that we've been seeing in this ratio. But things could always turn. It's just we have to go with what we see right now. When we look at discretionary versus staples, also, we saw some weakness after Tuesday. We're continuing to see some weakness in this ratio after Wednesday. Here's our trend where we're below the moving average and declining. The green line is still on top, but it is also declining. So we're in a positive trend, but it's a weakening trend. It's still an extreme positive trend. If these lines cross here, the green and the red line, that's going to turn the climate quite a bit. Here's the short-term chart where we're declining with the ADX below the moving average. The green line is on top, but it is declining. We are seeing a pickup in volume, but when we look at this oscillator, which measures over time, we haven't come back up and started to go positive yet. Sentiment is showing just a little bit of a tick up with fear. Looking at the Ulcer Index, we did go up with the VIX on the line chart as well as the bar chart. And we're seeing a little bit of a tick up here with the VIX of the VIX. We're getting above the moving averages with the bar chart as well as the line chart. This is something that I've been trying to point out. We don't know if this was really a valid signal. We came up close to this dashed line and then started to come down. This is the correlation between the VIX and the S&P. Other times when we get a high reading and start to come down, you can see what happened. Well, this is the 5-period moving average. You can see what happened with price down at the bottom with the S&P. A lot of times that marks short to intermediate term a decline that would happen after that. The thing that's a little bit questionable here is we didn't get a full-blown signal from this. We didn't go up to the dashed line. Was this enough of a signal? So far, yes. But we'll have to see how things end up playing out from here. Then when we look at the equity put call ratio, not really a surprise. It went up on the daily chart. It's continuing to go up on the 5-period moving average chart. That's negative short to intermediate term. We're seeing an increase of volume with this fear chart and also ticking up with fear on this other fear gauge that we look at. This is something that was showing some improvement, the risk on to risk off ratio. Now it's starting to go back down, giving us a little bit of cause of concern. The advanced decline line, we're still hanging in there with this, even though it's declining based on price and volume. we're still above the longer-term moving averages, and we're still flat with the 5 period when we measure our new highs minus the new lows, but we're declining with the 10 period. We're not seeing an expansion of new lows yet. We're just seeing a real contraction of new highs at this point. We're no longer extreme and we're positive still, but declining with the advanced decline ratio. Accumulation distribution is starting to roll over, but it's still above the moving average. The chicken money flow also showing some weakness after giving us an extreme positive reading. And with our cumulative NYSE advanced decline line, we did see some weakness, and then our regular NYSE advanced decline line also declined. And we declined with our other NYSE advanced decline line. We are coming off of a recent golden cross here, measuring the advanced decline line itself. So is this more of a pullback, or are we getting ready to see a real shift in the environment? When we look at common stock for the NYSE, we declined based on price and volume. I was trying to point out earlier that there was just a tiny bit of a negative divergence here where we were breaking out based on price. We were not necessarily breaking out based on volume. Perhaps that's coming into play now. Looking at our advanced decline line studies across the different markets, we had the NYSE common stock, the S&P mid caps and small caps, all declining, but they're still above an advancing moving average. Our short-term chart, we come right back down to this pivot point. Is that going to hold? That is also lining up with the 20-period moving average studies that we look at, and I'll show you that. When we have a short-term pullback, it's very common to come back to the 20-period moving averages. That's why we look at them. Is this going to hold? Are we going to be able to bounce up off of that? We're also coming back to this previous low when we had that really big down day back in December. Is this going to provide some kind of support? On the bottom, volume is now picking up to above average. Our 20-period exponential moving average is no longer extreme. We're still extreme with the 50 and 200, even though they're turning down. The Stochk RSI continues to be extreme negative. Here's the 20-period moving average study. We're coming down the blue line and the red line, which is the simple and exponential moving averages. This is the first line of support if things are going to maintain their positive stance. We're at that point now, seeing if we're able to bounce up off of that. Now, we might break down below this at some point in Thursday's session. It's where do we close? That's the important part. Then the force index. We've been seeing some negative divergences here. As the index was going up, the force index was actually going down. It's now turned negative. We've dropped below zero. The midpoint is turning down as well. The short-term stochastics are now turning actually more negative. We're no longer extreme with the intermediate-term stochastics. We're rolling over, but still extreme positive with the long-term stochastics. And again, I like to state every once in a while, this is a further subdivision of the short-term time frame. And we're coming right down to the midpoint with our standard deviations chart. We were riding up in this +3 area for a long time. We came down into the +2 after Tuesday. Now we're down even at the bottom end of the +1. So if the market's going to make a short-term stand, it's getting near the point where it needs to do that. Intermediate term charts. We are still declining with the balance of power, even though we are positive after being extreme. The go, no-go system still has the lighter shade of blue bars. That's where they change from being dark blue, which is positive, to more neutral blue, which are the lighter colored bars. We're coming down to the midpoint with our highest high, lowest low value. Will this end up providing support? We still continue to see some weakness on a momentum basis based on the TTM squeeze. We're still seeing the darker shade of blue bars. And we're coming down to now the double exponential moving average. We fell below the triple. That's the red line. We were wondering if the blue line, the double, was going to provide support, and we're just a little bit below that now. We're still positive, but we are declining with the ease of movement. And the Erin indicator is pretty much flat after giving us an extreme positive reading. This is still positive. The oscillator is above zero, but it is showing a little bit of weakness. And here's a little to short to intermediate term weakness that we're seeing. The S&P McClellan oscillator has now dropped below zero. So we're turning down based on price. We were already turning down based on volume. That's the problem with this, is we get a lot of signals sometimes based on volume. Some are legitimate and some are not. So we can't really take those to the bank, so to speak, but we are turning down. At least in the short term, it looks like the volume indicator was leading this time. The NYSE McClellan oscillator has also now dropped below zero, so we're starting to turn down based on price with the summation index for the NYSE and also turning down based on volume. We're still declining, but above zero with the Swenlin trading oscillator based on price. We're getting a little close to that zero level based on volume. We're rolling over with the PMO and we're crossing below the moving average. We've already crossed below the moving average based on price, and volume is actually a little bit more intense to the downside. And we were seeing some negative divergences here with the percent of PMOs that are rising. This was going down as the S&P was going up. The buy signals were going down as the S&P was going up. We're still extreme positive with the percent of PMOs that are above zero. We've turned to negative now with the Elder's Impulse system for the S&P. We're also negative for the second day now with the parabolic SAR. The slope oscillator dropping below its moving average, still giving us an extreme positive reading. The MACD is coming off of an extreme positive reading and also dropping below its moving average. So when we look at our oscillators, in the short term, we're rolling over. Intermediate term is starting to show some weakness. We're rolling over with our longer term oscillators as well after giving extreme positive readings. And we're right down to the 20-period moving averages in our moving average tree. We're starting to turn and go down now with the bullish percent index, but we have not dropped below 70, at least yet. We're turning down with the NYSE bullish percent index. We never did get up to 70, but the fact that this is turning down is negative in the short term. The fact that it's above 50 is more intermediate to long-term positive. And we're starting to come down now with the NASDAQ 100 bullish percent index, and we have not dropped below 70, at least yet. The Sean trend meter is no longer extreme and is showing some more intermediate term weakness. The Chaikin oscillator, it started to come down even before we finished the year and continues to be going down, but it's still above zero. And I wanted to point this out too. We're right at the midpoint with our Bollinger Bands as well. And this is just suggesting that there's a lot of short-term support where the market is at right now. And so watching how the market will behave going forward from here is pretty important if we're going to regain that short-term positive stance. The money flow is still above 50, but it is declining. The ultimate oscillator is starting to drop below 50 now. That's turning more negative. The vortex is declining, but the green line is still on top. The rate of change still continues to be positive. That's because it's coming back into this sideways area. And then, actually, it's coming down even further than that. But it's still giving us an extreme reading, even though we've been declining. The RSI 14 and 9, they are turning down. We're still positive with the 14. We're above 50. We're actually dropping a little bit below the midpoint with the RSI based on 9 periods. On balance volume continues to be positive, even though it's falling back. And we're still getting very high readings with the percent of stocks in the S&P above their 200-day moving averages. This gave us a really extreme reading. Yeah, it's starting to come down. And in the short term, we're pretty much flat here with the 50-period moving average study. Now, we're focusing on the 20-period moving averages for right now. If we lose that, then we're going to start to focus on the 50s. And that's what the bottom chart is, more intermediate term, where the upper chart is longer term. Pring Bottom Fisher is still saying, hey, it's time to party. And then looking at some line studies, we did start a new cycle on January 2nd. So far, that cycle appears to be down. We'll see how far that can continue. And with our 20-period simple moving average of the open, high, low, and close, we're starting to come down into this little mini rainbow now, thinking, okay, sometimes this will act as support. So we have some support to hang on to here. Is the market going to use it, or is it going to fall through it? Our different charts, we're turning more negative with the Heiken Ashi. We're actually turning negative with the red line now with the Kegi chart. Renko chart is still blissfully happy. We're turning a little bit more negative with the 3-line break. Long-term chart, we're coming down with the 150 and 200, but we're still quite extreme positive. And we're just a little bit above this long-term trend line with the weekly chart of the S&P 500. If we continue to fall, is this going to provide support? Please be aware, I draw the lines on here and I just kind of eyeball it. So this chart may not necessarily be exact. The same thing with this chart, the NASDAQ 100. We came up into this weekly chart of this longer term trend line, and now we're starting to come back down. The equal weight actually held up a little bit better than the mega caps, but both were still down. And this is showing, actually, let me take that back. The mega caps actually held up better than the equal weight. Because of this next chart, we actually went up with the ratio, showing that the mega caps weren't down as much as the equal weight index. But this is a negative divergence that we've been watching for a while. We were down with the Dow. We're declining and actually coming back below this previous high with the transports. And that's been a concern. And is the market dealing with that now? And we were up with utilities, even though interest rates ended up being down. The transports continue to underperform the Dow. We're still holding up okay with the Dow, just seeing kind of a normal pullback. And we continue to be neutral with the diamonds. But we're seeing a little bit more downward enthusiasm right now with the NASDAQ. We dropped below this pivot point. We held here after Tuesday. We've now fallen below that after Wednesday. Same thing with the NASDAQ 100. We were at this pivot point. Now we've dropped down below that. We've turned for the second day now negative with the QQQs on the Elders Impulse system. And we're turning more negative with the momentum with the NASDAQ 100 as measured by the PPO. And this, you got to be frustrated. If you've been waiting for this January effect to happen, it's like, okay, sideways, sideways, sideways. We shoot up, we shoot up, we shoot up, and then spend the next few days giving a lot of that back. But for right now, we've come back down to this pivot point. Is this enough doubt to give the small caps some support? Because this is a pattern that we've been seeing, shoot up, give back, shoot up, give back, shoot up, give back. Is it going to be a little different this time, or is it going to continue to decline? And the small caps have now turned to negative for the Elders Impulse system. We've also broken below this support level with the Russell 2000 index. We're dropping down with the RSI. We're turning negative with the momentum as measured by the MACD. The mid caps also came down and closed below this pivot point after generating a recent golden cross. We've turned negative with the Elders Impulse system for the mid caps. Financial sector, it was down, but it's still hanging in there. We're not seeing any kind of scary looking chart, at least yet. The FANG index has been giving back some gains, but still above its 50-period moving average and still in a longer-term uptrend. We're going to be watching this level here. If the FANG index continues to fall, are we going to come down, and will this provide support? The dollar was up, which also was putting some pressure on stocks. We were down with the 10-year yield, and we were up based on price, but that didn't give much support. And then looking at this historical chart that I'm trying to point out, I'll probably keep this in here for now. I may include it in the weekly video later. Last November, when we topped out with the 10-year yield and was starting to come down, is that signaling that something broke that we may not know about yet? And then looking at the 1 month to 3 month yield, it is coming down, but it's still positive, where we're crossing back and looking more normal on the daily chart when we look between the 1 month and 3 month yields. And then our growth to value ratios are showing some weakness now. The Qs to S&P, the discretionary to S&P, large cap growth to large cap value, all turning down. Large caps, mid caps, and small caps also showing weakness. We're still hanging out up here with our 10-day average of the S&P 500 highs minus the lows. But pretty soon, 10 days are going to catch up with us, and that might shoot this indicator lower, but we're not there yet. And we are seeing some weakness here with our highs minus the lows based on a 5-period moving average of the broad market, but we're still above zero. Our longer-term new highs, new lows study for the S&P 500, that's continuing to go up, and that's going to take a while to roll this over. That's a longer-term indicator. We were extreme positive with the S&P looking at the 50-period moving average study. Now we're starting to drop back down. We're also dropping back down with the mid caps as well as the small caps. The S&P to utilities ratio really chopping around right now. It had been going up, which was giving support to the S&P. Now it's chopping around as the S&P has been going down. We are still continuing to see the 2-year yield drop, but for right now anyway, the last couple of days, this is not giving much support to the S&P. We saw a spike up with the Staples to S&P 500 ratio. That's putting the S&P under pressure. But longer term, this ratio has been going down, which often supports the S&P. So what's our outlook for Thursday? The Santa Claus rally did not happen. Is the January effect over? Usually it goes up until about the middle part of January. Is it done for now? Is it going to resume? So those are questions we just want to ask. We are still positive. We're still dealing with an overbought situation, but we're seeing some weakness coming through. And we're going to be focusing, at least I'm going to be focused on the 20-period moving average and how to price at the close of Thursday's session. Are we going to be above or below that 20-period moving average and all the different support levels that are now coming into play? We will get the weekly jobless claims, the ADP employment change, and then the services PMI. We had the non-services or manufacturing PMI on Tuesday. Now we're going to get the services PMI. Keeping an eye on the geopolitical events. Anytime something happens there, it can influence the market. And I forgot to, no, I guess I didn't forget to. We will be getting the big employment situation report on Friday, as well as another big economic report, the ISM non-manufacturing. Seasonally, and I did change this over to January, we won't know the answer to this until January is finished, but 72.6% of the time, how goes January, so goes the year. Looking at the Stock Traders Almanac statistics for January 4th, the Dow is neutral to positive, as is the NASDAQ, where the S&P tends to be positive. It's up 61.9% of the time. We will be on the third trading day of the month. During an election year, we do see it's kind of sideways to slightly higher. And then we're wondering about this whole January effect thing here. Even when we do see this going up, it doesn't mean that it goes straight up. Are we hitting a bit of a hiccup, or have we started to end this actual phenomenon? And we're also keeping an eye on the comparison between 1982, which did see prices really go up, with what was happening in 2023. Are we going to stick with that? I'll probably only show this chart another time or two and then delegate it over to the weekly video. And then looking at seasonality during an election year. That's the dark blue line. And notice they don't start off with real gangbusters based on this chart. Now, there's another chart that we look at that does show things quite positive. But this chart has us more or less chopping sideways. And this chart also is more sideways. We're looking at the green dashed line for the S&P 500. This is the chart that tends to be more positive. When you have the sitting president who's running for re-election, that's what we know so far. We'll see if that ends up changing. But that's the green line that we're following, which does suggest positive seasonality. And Thursday ends up being okay as far as 2023 was concerned for being an up day. It's still Monday that's the best, followed by Friday. And then this is something I'll probably include for a little while. For the whole month of January, from 1950 until right now, during an election year, we're 50-50. So we don't seem to really have an edge one way or the other. So our scenarios, can't really go with the down one yet, even though we are showing some weakness, even though we are still dealing with an overbought situation. In the intermediate and long term, we still continue to be positive, and we're at support in the short term, wondering what's going to happen from here. We are concerned a little bit about the trend because both of our ADX charts are still extreme. Even though they're coming down below their moving averages, they're still both well above 40. So if anything, we would still default to the positive side, but we have to see price follow through with that. I don't buy on weakness. When I'm looking to go long, I buy on strength. If I'm looking to go short, I sell on weakness. I don't do this buy the dip kind of stuff because people get trapped like they've been trapped over the last couple of days, and it just kind of can ruin your whole year before it even really starts. All right. So the warning signs. Growth, this has been a concern now for quite some time, and it's showing weakness. The equity put call ratio based on 5 periods is still going up. That's negative. The transports are negatively diverging from the Dow. That's negative. The 1 to 3 month short-term bond spread, it continues to be positive, even though it's been coming down and improving. The parabolic SAR and the Copic curve charts are negative. The momentum for the NASDAQ 100 has now turned negative. Positive signs. We're still okay with the daily special K chart. Our longer-term equity put-call ratio is still going down. The risk-on posture, this is kind of in the balance right now. We've seen a couple of down days, actually 3 down days with this ratio, and it's starting to show some weakness, but in the bigger picture, it's still looking positive. Our oscillators are positive, but they're rolling over after giving us extreme positive readings. The vortex and the BPI, they continue to be positive, but they are coming down. The Zohorchak method has not changed. The Russell, the small caps, and the mid caps, they are working off of recent golden crosses. I showed you the charts of small and mid cap growth. They're pretty much chopping sideways. The mid caps were showing more strength. Now they're starting to give some of that back. The financial sector, even though it was down in Wednesday's session, it still continues to be positive. And I should have adjusted the spacing here. The new high, new low study on the S&P continues to be positive. I even meant to do that. Okay, so our conclusion is we're still dealing somewhat in the intermediate term with an overbought condition. We've worked off most of it in the short term. Is weakness developing? Is that weakness going to turn into more of a decline, or have we worked this off now? In the short term, will the 20-period moving average end up providing support? Intermediate term, if we lose that 20-period moving average, we're probably going to see more weakness in the intermediate term, where we continue to be positive in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.